In this video, we are going to cover what needs to be considered by the auditor at the acceptance stage of an external audit. This is the very first stage in the audit process, and it is in general terms whether they should continue the audit assignment. There are two situations. Either the auditor will be considering whether they continue to act for an existing client, or they will be considering whether to accept a new engagement. Either way, both of these situations will require the same process to ensure the correct decision is made by the auditor. The new audit clients are generally gained by three methods: client request, advertising, and tendering. Clients are often recommended by existing clients and may contact the auditors directly to take on their audit work and other services. Advertising services often results in new clients approaching them. The tendering process often occurs with larger, often listed clients. It is where several audit firms will set up presentations to the potential client to promote themselves as the best audit firm for the assignment. The company will then select which audit firm they were most impressed with. Whichever way the auditor gains a new client, care should be taken as to whether the client should be accepted. There are many considerations as to why they may not want to accept an audit assignment. These considerations can be split into two stages: the preconditions of an audit and any other acceptance considerations. Stage 1 is the preconditions of an audit. If the auditors are not satisfied with the preconditions, then the auditor should not continue any further with the audit assignment. ISA 210 tells us that the preconditions are: is the client following an acceptable financial reporting framework? And does the client management accept their responsibilities? The auditor would need to consider whether the financial reporting framework is appropriate. For example, is it consistent with previous years, as well as if it is appropriate to the organisation? In terms of management responsibilities, they must accept that they prepare the financial statements in accordance with applicable reporting framework, ensure controls are sufficient to ensure financial statements are free from material misstatements, and provide the auditor with all relevant information and explanations necessary to complete the audit assignment. As I mentioned before, if the preconditions are not present, then they should not accept the audit assignment. Once the preconditions have been identified, the auditor must move on to any other considerations that may affect their decision to continue the audit. We will go through each consideration in detail. Professional clearance. If the audit firm has been approached to audit a new client, the best source to identify if there were any issues which may cause them not to accept would be the previous auditors. Therefore, they should write to the previous auditors and ask them if there are any professional reasons why they should not accept the audit assignment. This is known as a professional clearance letter. Professional reasons not to accept may include overdue fees still owing to the previous auditors, breach of law and regulations discovered by the previous auditors, disagreements with management during that audit, and a lack of integrity from management which may affect the auditor's reputation. It is important to review this feedback to ensure a client is not accepted who may risk causing the audit firm to act unethically or unprofessionally. This feedback affects confidentiality as it is discussing client information with a third party. Therefore, permission is needed from the client to write to the previous auditors, and the previous auditors must also get permission in order to respond. If permission is not given, it is unlikely that an audit firm would feel comfortable continuing with this assignment. Auditor considerations. I gather all practical concerns the auditor may have under one heading. They must review the time needed, the skills required, and the fee. The audit firm must ensure it is practical to take on an audit client. Audit firms must ensure that they have the time to complete the audit work properly. If they already have a very busy time of year where a lot of their clients have the same year end, it would not be sensible to take on another client with the same year end and therefore similar deadlines to other clients. This may affect the quality of the audit work provided. They must also ensure that they are able to complete the audit work competently. Just because an auditor can audit one type of business, it does not mean they have the skills to audit them all. Therefore, they must ensure they have the necessary skills and experience to deal with every client. The fee should also be considered. Fees must be based on the amount of work expected from a client. Any contingent fee should not be accepted. The risk of non-payment should also be considered by the audit firm. Audit risk considerations. While the auditors may not yet have access to all books and records, it is important to identify any issues that may indicate audit risk is high. Audit risk is the risk of the auditor giving an inappropriate opinion, and this risk should always be kept to an acceptable level. If there are indications that there is an unacceptable level of audit risk associated with the client, then the audit assignment should not be accepted. Ethical considerations. The auditors need to ensure they maintain their ethical standards so as not to affect their reputation or the reputation of the profession. At the acceptance stage, they must identify if there are any potential conflicts of interest with existing clients. If there are, both clients need to be made aware, and if they are both happy to continue being audited by the same audit firm, then appropriate safeguards for confidentiality must be implemented. The auditors must also identify any potential threats to objectivity. These are self-interest, self-review, familiarity, advocacy, and intimidation. Again, any threats must be identified, and they must consider if they can be managed. If not, the assignment should not be accepted. Based on all of these issues, a decision is then made as to whether they should accept or reject the client. If the risks are too high being associated with the client, then they should reject. If they accept, the auditors then move on to the next stage of the audit process, the engagement letter. I hope you found this video useful. Thank you for listening. This video will cover the engagement letter. The engagement letter is an agreement that is put in place at the start of the audit process. Once the auditor has concluded the acceptance stage and agrees to continue with or accept a new audit engagement, the engagement letter is prepared. In this video we must cover the purpose, ISA 210 agreeing the terms of audit engagements, and the contents of an engagement letter. The engagement letter is a way of communicating and agreeing the audit process with the audit client. Its main purpose is to minimise the risk of any misunderstandings between the two parties and reduce the expectation gap. This is the difference between what auditors actually do and what many perceive them to be doing. Explain the audit process and the terms and conditions of the audit engagement, and it acts as a way of both parties accepting the audit process in writing. ISA 210 states that the engagement letter should be prepared, agreed and signed by both the auditor and the client before any audit work starts. The engagement letter contents should be reviewed every year to ensure it is up to date. Any changes in the engagement would mean the engagement letter should be updated. A new engagement letter is not required every year if changes have not occurred. ISA 210 also outlines the contents of an engagement letter. The main contents should include the objective and scope of the audit, the auditor's responsibilities, the client management responsibilities, the financial reporting framework, and the form and contents of any reports used. The objective of the audit is to provide sufficient appropriate evidence to form an independent opinion on the financial statements. The scope of the audit is to plan and perform audit procedures to audit the financial statements, including the statement of financial position, the statement of profit and loss, statement of changes in equity, and the statement of cash flows. The auditor's responsibilities are to carry out their audit in accordance with auditing standards. They must plan and perform audit procedures to give reasonable assurance on whether the financial statements show a true and fair view. They must obtain sufficient and appropriate evidence to form an independent opinion, and they must communicate any issues, including any deficiencies found in control systems, to management. The client management responsibilities are to prepare the financial statements properly following relevant financial reporting standards, ensure controls are sufficient to ensure the financial statements are free from material misstatements, and to provide the auditor with access to all relevant books and records and provide information and explanations required. The engagement letter would also include a mention of the financial reporting framework being followed when preparing the financial statements, for example, International Financial Reporting Standards. Throughout the engagement letter, it will mention the form and contents of reports. For example, the formal written audit report at the end of the audit process will show the audit opinion. Any control deficiencies will also be reported in writing in the form of the management letter or report to management. In addition, other matters may also be included, for example, confirming the use of experts during the audit engagement, the basis of fees, the reliance of some of the internal auditor's work if appropriate, acknowledgement of any specific regulations relating to the audit, provision of additional services, the limitations of an audit, and the timings of any communications during the audit. If the engagement letter is not reviewed every year, the information within it may be out of date. The auditors may provide additional services not included, or the fee basis may have changed. In addition, if there is not an up-to-date signed copy of an engagement letter, then the auditor has not received confirmation that the management accept their responsibilities. This could cause problems later on in the audit, and without an engagement letter, the audit standard ISO 210 is not being followed. I hope you found this video useful. Thank you for watching. This video is going to cover the topic of audit risk. The aim of this video is to gain an understanding of the factors that must be considered by auditors when deciding what is an acceptable level of risk associated with a client. The definition of audit risk is the risk that the auditor gives an inappropriate audit opinion, i.e. there are material misstatements present in the financial statements. Before we go into the practicalities of audit risk, let us ensure we understand what material misstatements are. This is defined in ISO 450 as a difference between the amount, classification, presentation or disclosure of a reported financial statement item and the amount, classification, presentation or disclosure that is required for the item to be in accordance with the applicable financial reporting framework. Misstatements can arise from error or fraud. This is a very wordy definition and difficult to remember. To help remember, we could summarize as follows. A misstatement is the difference between what is in the financial statements and what should be in the financial statements in accordance with the applicable financial reporting framework. These material misstatements, if present in the financial statements, could cause inappropriate decisions to be made by the users of the information. For example, a decision could be made by the bank to give finance to the company based on the financial statements. In reality, if a material misstatement is present in liabilities, causing them to be understated, once corrected, the lender may not come to the same conclusion. If there are material misstatements present and the auditor states in their opinion that the financial statements are true and fair, then their opinion is wrong. This leads to users making incorrect decisions, but also could lead to others questioning the auditor's competence, therefore affecting their reputation and future client relationships. The aim is therefore to keep audit risk as low as possible for every client. Auditors must identify the risks associated with the client at the planning stage of an audit. To calculate audit risk for each client, they use the audit risk model. This is shown as follows. AR, which stands for audit risk, is equal to IR times CR times DR. Each of the three components of audit risk in the model need to be considered by the auditor to decide the level of risk. IR is inherent risk. This is the risk of a material misstatement in the financial statements due to the nature of the client, whether it be the business itself or the industry which they operate within. Inherent risk may be high due to the level of regulation that must be followed by the client. If heavily regulated, there is a stronger risk they may have not followed industry rules and disclosure in the financial statements may be inadequate. It could also be related to what they trade in or produce, for example. If the products are frequently being improved and replaced by new products, there is a risk inventory held in the financial statements may not be valued correctly, leading to material misstatements. Clients trading in technology are always high inherent risk clients. The auditor cannot change the level of inherent risk. They must identify it and then plan how to manage it. CR is control risk. This is the risk of a material misstatement in the financial statements due to poor client controls. Control risk may be high due to the financial reporting system itself. For example, it may not be integrated with other systems which provide it with information. If human input is required, this increases the risk of misstatements being present. Control risk may also be high as the client does not perform adequate control procedures within their business. To give you an example, if the client does not perform a year-end inventory count, it increases the risk of the inventory balance being materially misstated. Again, the auditor cannot change the level of control risk. The auditors can recommend changes for the future. For now, these issues must be identified to decide the level of and type of audit work needed. DR is detection risk. This is the risk of a material misstatement in the financial statements due to the auditor not spotting the error. This is the one element of the audit risk model that the auditor can do something about. The auditor must ensure that their audit procedures carried out during the audit process are able to detect misstatements that could be material. The level of work needed will depend on the client's circumstances. If the client is imposing a tight deadline, it may mean the long working hours could cause misstatements to be missed, or the auditor may cut corners to get the work completed on time and perform less procedures than they should. If the client is new, the audit team may lack knowledge of the business, which could mean they miss something important in spotting a misstatement. So we can see that inherent and control risk cannot be changed. The auditor therefore needs to identify these risks, which will then help them decide what the detection risk level can afford to be. This audit risk model needs to ensure the overall audit risk is kept as low as possible. If the auditors have a tricky client and inherent and control risk are high, then detection risk must be low. The only way to reduce detection risk is to increase the work carried out on the audit. More audit procedures would be needed. More time should be spent on the audit. Sample sizes should be increased, and even more experienced audit staff should be used to help detect material misstatements. If the client is a fairly stable one with no previous or current issues in a non-risky industry, then detection risk can afford to be a little higher. This does not mean the auditor relaxes the rules when carrying out the audit work, as they still must follow auditing standards and ensure they have collected sufficient appropriate evidence to form their independent opinion. What it does mean is that they can afford to test smaller samples of transactions and therefore spend less time on the audit in comparison to a more high-risk client. The audit risk model is key to understanding audit risk. The three components, inherent risk, control risk and detection risk, identify the overall risk of the auditor forming an inappropriate opinion on the financial statements. Remember that the nature of the client's business and industry and the quality of their control systems could cause material misstatements, and these risks must be identified by the audit team at the planning stage. They then need to decide on the level of acceptable detection risk. For detection risk to be low, more audit work and time spent is needed by the audit team. This all then helps decide on the audit procedures needed to be carried out and the key financial statement balances that need most focus. If audit risk is assessed correctly, the audit opinion will be appropriate at the end of the process. I hope you found this video useful. Thank you for watching. This video is going to take you through the practical steps that an auditor follows in order to identify audit risk. We have covered the theoretical understanding of audit risk in another video, and we use this knowledge, just like the auditor does, to find the issues that increase audit risk with a client. Audit risk is the risk of the auditor giving an inappropriate opinion on the financial statements, for example stating the financial statements are true and fair when there is a material misstatement uncorrected. The auditor has the audit risk model to understand and calculate audit risk. They categorise the risks into 3 areas: inherent risk, control risk and detection risk. The aim is to identify the risks and then plan how to manage these issues to keep the overall audit risk at an acceptable level. ISA 315 requires auditors to perform risk assessment procedures. ISA 200 requires auditors to apply professional skepticism during the audit, including planning the audit. This means they must be alert to issues that may cause misstatements and have a questioning mind when carrying out their work. Both of these auditing standards help guide the auditor through the planning stage and ensure audit risk is assessed properly. The auditor must somehow identify audit risks so they can be included in the plan. The risk assessment includes 2 main pieces of work carried out at this stage: understanding the entity and its environment, and using analytical procedures. Both of these methods will help identify potential material misstatements and will allow the auditor to factor in the time and work needed to ensure their opinion is an appropriate one. When obtaining knowledge of the business, the auditor must gain an understanding of the structure of the organisation, the industry it operates in, as well as any events that may be relevant to the audit. At the planning stage, the auditor will have access to all books and records, plus they will also be able to discuss issues with the client management and staff. Therefore, the 3 main methods of gathering information about the client are inquiry with management and staff, observation of control procedures carried out, and inspection of important documents and procedure manuals. To understand an entity fully, the auditor must gather information on the following: industry and other external factors that impact on the client and its accounts, laws and regulations directly affecting the operations of financial statements, the client organisational structure, including how it operates, who owns it, any investment it makes, and the management structure, the accounting policies it follows, the client business plan and risks, the financial performance, and internal controls. This is a lot of information to gather at the planning stage. However, there are many sources where this information can be obtained. The 4 main sources of information are: within the audit firm, from external sources, from the client, and from the individual auditor. If the client is an existing one, much of the information can be gathered internally within the audit firm. The previous audits will have gained a lot of background information about the client and its structure. Therefore, the previous year's audit files holding the working papers and the permanent audit file will be a good source of information. Discussions with the audit partner, who will have much knowledge about the client, along with the audit manager, is also advisable. Previous year's audit teams will also be able to assist in the understanding of the client. External sources will give you some independent information about the client. These include Companies House, where information on the structure and financial statements can be found. The Internet and trade press, where auditors may find events relating to the client that may be relevant to the audit and the financial statements. Industry surveys and credit reference agencies will also give relevant information on how they've been performing and their financial position. Information from the client regarding their systems and controls and any events relevant can be obtained from the following: discussions with client management and staff, observation of procedures, their website and any brochures. Finally, understanding the client also takes some audit experience. Past experience from similar clients, for example, will ensure the auditor can identify what is necessary for this particular audit. Now we have discussed the work in understanding the entity, we can move into the other key piece of work in identifying audit risks: analytical procedures. The definition of analytical procedures is given in ISA 520 as evaluations of financial information through analysis of plausible relationships among both financial and non-financial data. I like to put it more simply as comparing financial and non-financial data to understand changes. This is an important tool within the audit process and it must be used at the planning stage. Auditors are also advised they must again use analytical procedures at the end of the audit process, at the completion and review stage, and can use it to gather evidence during the substantive testing stage. The purpose of performing analytical procedures at the planning stage is to understand the business the client operates, identify unusual balances and transactions and events that may indicate potential audit risks, and identify potential material misstatements due to fraud and error. The way the auditor does this is to compare the most up-to-date set of financial statements, for example a draft set of financial statements, to the previous year, budgets or forecasts, and industry averages with the use of ratios. Knowledge of ratio calculations is required here, as this accounting tool will help highlight potential issues with the numbers better than just looking at the figures in the financial statements. Ratios can be categorized to review the following: profitability, efficiency, liquidity, and return. Profitability ratios include the gross profit margin, calculated as gross profit divided by revenue multiplied by 100%. Net margin is calculated as profit before tax divided by revenue and multiplied by 100%. And these ratios will give you the proportion of profit to revenue in a percentage form. Efficiency ratios include receivable days ratio, calculated as receivables divided by revenue multiplied by 365 days. Payable days ratio, calculated as payables divided by purchases multiplied by 365 days. And inventory days ratio, calculated as inventory divided by cost of sales multiplied by the 365 again. These ratios will give you the average number of days customers take to pay, the client pays suppliers, and inventory is held in the business. Liquidity ratios include the current ratio, calculated as current assets divided by current liabilities, and the quick ratio, calculated as current assets minus inventory divided by current liabilities. These ratios will show you how comfortably the company can repay its current liabilities. Return ratios, such as the gearing ratio, will show you how much debt is in the business. This is calculated as debt divided by equity, or borrowings divided by share capital and reserves. The auditor can calculate ratios on the current figures in the financial statements and compare them to the previous year budgets and industry averages. This will then highlight unusual differences in results, which can then be investigated in more detail during the audit. Any unusual results from analytical procedures could be the result of a material misstatement. Therefore, lots of variations in figures and disclosures would increase audit risk. To summarise, to help calculate audit risk, the auditor must identify potential issues that could cause misstatements. There are two main methods the auditor uses: understanding the entity and its environment, and analytical procedures. The less that is known about the client, the more work is needed to ensure the auditor understands fully the potential issues that could cause misstatements. There are many sources where information can be obtained, and the auditor must use those resources available, including talking to and observing the client staff and management. Review of the financial statements is also important, and using analytical procedures is required as per auditing standards. All of this information obtained from the work we have discussed must be documented in the audit file. This will ensure there is evidence that the work to identify audit risks was in accordance with auditing standards. I hope you found this video useful, and thanks for watching. This video is going to cover the laws and regulations that surround our external auditor. We will need to cover the regulatory body, who requires an external audit, who is allowed to form an opinion on the financial statements, the rights and duties of an auditor, and auditor's appointment and removal. External auditors are regulated to ensure their work is effective, consistent, and their credibility remains intact. There have been historical events such as the collapse of Enron that have caused issues with the reputation of the profession. This has led to tighter controls on what the auditors do when carrying out an external audit. External auditors must therefore follow strict guidance to ensure their work is of the correct standard and maintains that credibility needed so that their opinion is valued. This includes the Code of Ethics, which is guidance on behaviour of the auditor. This is covered in detail in another video. Auditing standards must be followed, which is specific advice on areas of the auditor's work. And corporate law specific to where they are based and where the client operates. The IFAC, International Federation of Accountants, is a global supervisory body. They are an organisation working on consistency of accountants across the globe. They have subgroups which then take on specific, more detailed responsibilities for each area of the profession. The IAASB, International Auditing and Assurance Standards Board, is the group that looks after the external auditor. They have two key outputs: the development of the International Standards of Auditing, or ISAs, of which there are currently 36, and the International Standard on Quality Control, or ISQC, of which there is only currently one. ISAs are published in a book, regularly reviewed and periodically updated by the IAASB. Each ISA gives the auditor specific guidance on elements of the audit process and must be understood and followed by the auditor. Only in exceptional cases would an auditor be able to depart from the standard guidance. Their decision would need to be justified. For a new ISA to be developed, there is a lengthy process. This will include lots of discussions with interested parties and debates over whether a new standard should be created or a current one adapted. The steps include a debate within the IAASB on the issue. If concluded there is a need for a change in the ISAs, they will issue an exposure draft, which is a draft of the standard made public for feedback from interested parties. Comments from external parties are taken on board and approval from the IAASB is sought. Finally, the new or adapted ISA is published. Many countries may have created their own version of auditing standards and choose not to follow the international ones. This is permitted as the IFAC has no legal standing in each country. In the UK, the Financial Reporting Council has adopted and modified the International Auditing Standards. In addition to auditing standards, the auditor must also ensure they follow relevant corporate law. Corporate law differs from one country to another, So we are going to look at the general requirements for an auditor from UK law and the Companies Act 2006. Registered companies are required to have an external audit. In the UK, there is a small companies exemption which allows small companies to not appoint external auditors. These companies need to have revenue at less than 6.5 million. They can still have an external audit if they wish, but there is no legal requirement. This helps small companies, who are often owner-managed and have fewer control systems and staff, to not be burdened with an external audit whose expense often outweighs any benefits. There are no real restrictions on who can be part of the audit team. However, those responsible for the audit and the decisions made on it are referred to as practitioners. These practitioners are required to be a member of a recognised supervisory body, or RSB, and be allowed to be a practitioner by their rules. Examples of these RSBs include the ACCA and the ICAEW. Once a member, they are allowed to form an opinion on the financial statements and sign the audit report. For the auditor to conduct their audit properly, they need to ensure they have everything in place to allow them to do their job. Their key rights are: they must be allowed access to all relevant company books and records. They must be given all information and explanations necessary to complete their audit. They must be informed of when and be allowed to attend any general meetings between the management and the shareholders, including the AGM, and they are allowed to be heard at such meetings. They must also be given copies of any written resolutions of the company. The auditor's duties are to audit the financial statements and form an independent opinion on them, stating whether or not they are true and fair. They must also report on any specific legal requirements relevant to the company being audited. And they must also ensure they follow the auditing standards and their ethical code while carrying out the audit. Auditors are generally appointed by the shareholders. This is usually done by vote, with the majority decision being taken. However, there are some exceptions to the rule. If it's the first year that the audit has been required, or it is the first year the company has been set up, the directors are allowed to appoint the auditors initially. This is to ensure that they have an auditor in place as soon as possible, rather than waiting until the AGM at the end of the year. Once the first audit has been completed, it is then the shareholders' right to vote to decide whether to keep or change the external auditor going forward. If neither the directors or shareholders have appointed the auditors, and deadlines for submission of an audit report have passed, then the government would usually step in. They would then appoint an audit firm to complete the work for the company. This is an extreme measure and is quite rare, but the rules are in place to deal with this if it happens. There are two main situations where an auditor would no longer act for the company. Either they are no longer able to act for them and resign as auditors, or they are sacked or removed. There are many reasons why the auditors may resign. It may be that being the auditor could affect their ethical behaviour, or the integrity of the directors and their relationship with them has changed, and they feel they should not continue with the audit. Whatever the reason, the auditors must notify the company and the shareholders in writing as soon as possible. They issue a statement of circumstances, which gives the reasons for the resignation, and would then be available to assist with a handover to the next audit firm appointed. The shareholders will be responsible for removing the auditors. If the majority vote to remove or sack the auditors, then they continue with this decision. Once decided, the shareholders then need to inform the directors and the auditors. Notice is given to both the directors and auditors. Written confirmation is sent to both parties, informing them of the decision and giving notice to ensure any issues are tied up before the auditor leaves. If the auditor feels that the decision is unjust, they have the right to send a response to all parties explaining why they should not be removed. To summarise, auditors are regulated by the IAASB. They are expected to follow the auditing standards and ethical code when carrying out their work as an auditor. They must also follow any other relevant laws and regulations, for example, local legislation that is relevant when working for the client. The laws and regulations not only ensure the auditor carries out their work properly, but it also protects the auditor, for example, giving them rights that enable them to carry out their work with few complications. Not every country follows international auditing standards. Many countries may have their own set of auditing standards. However, very often, like in the UK, the international standards are adopted with some modifications. I hope you found this video useful. Thank you for watching. This video will cover how fraud relating to an audit client is managed by the audit team. ISO 240, the auditor's responsibilities relating to fraud, tells us that the auditors have a duty to identify and communicate any evidence found that fraud is present. Auditors have a responsibility to obtain reasonable assurance that the financial statements as a whole are free from material misstatements, whether they arise from fraud or error. The key difference between fraud and error is whether the misstatement was intentional or not. Fraud is criminal activity. There are two types the auditor may see. One is where there is a deliberate misstatement in the financial statements. This is known as fraudulent financial reporting. The other is the theft of company assets or misappropriation of assets. The auditing standard does not state that it is the auditor's responsibility to prove whether fraud has happened. Their responsibility is to identify misstatements during the audit process and assess whether they are as a result of fraud or error. The responsibility for ensuring fraud is not present in the financial statements and the company as a whole still remains with the directors. This is sometimes referred to as a primary responsibility towards fraud, with the auditor's responsibility being referred to as secondary. This is because the auditors are given some responsibility, not all, as they assess the risk of fraud based on the systems and transactions reviewed during the audit process. For the auditor to maintain their responsibility, they must maintain professional skepticism throughout the audit process. An inquiring mind can open up things that have been concealed within the organisation. Assess any audit risks that could lead to fraud. Incentives to commit fraud should be considered, for example, bonus schemes based on profit margins. Generally assess the risk of material misstatements for the entity. Review how management react to and manage fraud. Talk to management to see if they are aware of any instances of fraud, and gather sufficient appropriate evidence from audit procedures designed to assess the risk of fraud. If the risk of fraud is high, the auditor must plan appropriate procedures to ensure that they are in the best position to detect fraud. They can ensure more experienced audit staff are available for the audit team. Increase sample sizes. Change audit procedures from what they would normally do, as being less predictable could catch out anyone trying to conceal fraud. Focus more on balances containing estimates from management, as this would be a popular area to manipulate figures. And also focus on the transactions posted around the year end, as cut-off errors often are an intentional way of increasing or reducing balances. If fraud is found by the auditor, there are some simple steps to follow. Report it to those responsible for the audit team, for example the audit manager and audit partner. They should then consider the evidence obtained and report this to the highest level of management at the client. If the auditor is suspicious that the management are involved, they should seek legal advice and consider whether they would report externally. Caution should be taken when reporting externally, as the auditor has a duty to maintain confidentiality. If the evidence collected on fraud is incorrect, they would have had no reason to break confidentiality. If the fraud detected is material to the users of the financial information, then the auditor would need to modify the audit report to make the shareholders aware of the issue. In summary, fraud is an intentional act to deceive. The auditor may detect this as fraudulent financial reporting or misappropriation of assets. ISO 240 states that they have a responsibility to assess the risk of fraud and perform audit procedures to identify fraud. However, it is the director's responsibility to ensure fraud is not present in the organisation and the financial statements. If fraud is found, the auditor must report this and consider whether it is material and whether the audit report should be modified. I hope you found this video useful. Thank you for watching. This video is going to walk you through the planning process of an external auditor. We are going to cover the purpose of the plan, how the auditor spots risks, the audit strategy, materiality and performance materiality, and the written audit plan to be included in the audit file. ISO 300 states that the objective of planning the audit is to ensure it is performed in an effective manner. Indeed, the purpose of planning anything is to ensure it goes well, and so the more effective the plan, the more effective the audit will be. There are some key reasons why a plan is so important for an audit. It will ensure the auditor can give enough attention to the more problematic areas. It gives the auditor time to assess the risks associated with the audit before they start the audit work. They are able to plan appropriate audit procedures in relation to these risks. They can select the right level of experience needed on the audit team and consider the need for experts and assistance from internal auditors, which can then be planned properly. This should all ensure that the audit meets deadlines so that the financial information can be presented on a timely basis. The first stages of an audit process must include the audit team ensuring they will not have any problems being able to follow their ethical code, and ensuring they understand the specific requirements of this audit client by reviewing the engagement letter. Initially, the audit plan begins with identifying potential audit risks. This is the risk of the auditor providing an inappropriate opinion, for example reporting that the financial statements are true and fair when they are not. The auditor must assess risks using the audit risk model, identifying inherent risks, the risk of material misstatements due to the nature of the entity, control risks, the risk of material misstatements due to poor controls, and detection risk, the risk of material misstatements due to the auditor not spotting the error. There are two main pieces of work that assist them in identifying anything that could increase these risks. These are analytical procedures and understanding the entity and its environment, or knowledge of the business. Analytical procedures are a comparison of financial and non-financial data to help the auditor understand material changes in the financial statements. Used at the planning stage, they will have a set of draft financial statements that they can compare to the previous year, industry averages, and any budgets or forecasts produced. With the use of ratios, they can identify changes in balances, which may then need to be investigated when carrying out their audit procedures later on. At the planning stage, once identified, they can design audit procedures that will focus on any areas where more investigation is needed. Understanding the entity and its environment is important, as if the auditor lacks a fundamental understanding of what the client does, there is a real risk that they may make poor decisions and issue an inappropriate opinion. Thorough investigation of what the client does through the audit firm, through the client themselves, any external sources, and using the auditor's expertise will enable them to find anything that could indicate the audit risk could be higher than expected. Once any risks have been identified and considered, then the auditor must produce an audit strategy. The audit strategy is to identify the overall plan for the audit. It always comes before the detailed plan, as it enables the audit team to see what should be included and how much work will be required. we can separate the audit strategy into three components. The auditor will need to consider the scope, the timing, and the overall direction of the audit. The scope is the specific details relating to the audit for the client. This could include the auditor identifying how many locations the client has so they can plan where they need to travel to. It could include the systems that the client uses and whether there have been any changes, for example, a new upgraded financial reporting system. This would require the auditor to ensure the system is reliable and is understood by them, which will take time. These specific details relating to the client are now identified so plans can be made to address them during the audit. The timing of the audit is also important. The audit team must ensure they provide their audit report in a timely manner so that the financial information can be presented at the AGM to the shareholders. The auditors therefore need to consider when areas of the audit process should be completed by. They should book audit staff so that they are available to be part of the team and arrange when they are visiting the client. Depending on the size of the entity, the auditor may need to include an interim and a final audit. Medium to large size companies usually require both, so there is enough time to complete all of the audit work. An interim audit will take place before the year end. This can be shortly before the year end when much of the events have already occurred. Here they can plan, assess control systems, and perform some of the substantive audit procedures on transactions that have already occurred. This then frees up much needed time after the year end for the final audit, where further substantive testing and completion and review procedures are finalised. The direction of the audit is where the auditor decides what style of procedures are required and the volume of work needed. Based on the work to identify risks and some review of control systems, the auditor will be able to determine whether control systems look reliable. If this is the case, then the direction will be controls-based, where they conclude systems are reliable and sample sizes and the overall level of work needed for the audit can be reduced. If control systems look unreliable or there appears to be many indicators of high audit risk, the direction is procedural. There will be detailed audit testing, larger sample sizes, skilled staff needed and more time. One of the important decisions to make at the planning stage is to decide what is a material misstatement. Remember, if something is material, it means it can influence the users of the financial information. The auditor has guidelines to follow on what materiality can mean in relation to the financial statements. Something can be material by its size or by its nature. If an item is material by size, if incorrect, the auditor would request that the client correct this in the financial statements. If they don't, the auditor would conclude that the financial statements are not true and fair. The guidelines on materiality are that an item is material if it is above 5 to 10% of profit, 0.5 to 1% of revenue, and 1 to 2% of total assets. At the planning stage, the auditor must decide what basis they are going to use and what percentage. They use their own experience and judgment to decide this. For example, if the company has many high audit risk indicators and they believe there is a risk of many material misstatements, they may choose to lower the percentage, for example, set at materiality at 5 or 6% of profit. This will allow them to investigate more misstatements in detail. If they feel that profit may be distorted as costs may not all be present, then they may select revenue to calculate what materiality should be. Some balances by their very nature are going to be material to the users. A prime example is directors' transactions, which must be transparent to the users. If the auditor finds any misstatements relating to this, they must be corrected regardless of their size. The auditor must also consider and set performance materiality at the planning stage. This is a smaller amount than materiality, usually a percentage of the materiality they have calculated. The idea is that if any misstatements identified while performing audit procedures are above performance materiality, they are recorded. This is usually in a spreadsheet, often called the summary of unadjusted errors or evaluation of misstatements. At the end of the audit process, at the completion stage, this spreadsheet is reviewed. The auditor is looking to see if there is an accumulation of smaller errors that actually add up to a material misstatement. The auditor would then request that this group of errors, which are now collectively material, be adjusted in the financial statements. Let me give you an example. Let's say a company has a profit of $20,000 and a set materiality at 10%. This means any misstatements found that are $2,000 or more are material to the users and should be corrected. The auditor also sets performance materiality, let's say 20% of materiality. This means any misstatement above $400 should be recorded on a spreadsheet to be reviewed later. The auditor then performs their audit procedures and finds the following errors in the payables balance: $500, $1,600 and $1,400. In isolation, none of these are material. However, they all relate to the same balance and collectively add up to $3,500, which is material to the users. In this example, there would be a request to amend the financial statements for this amount. Once the auditor has spent time on the audit strategy and considered details relating to the audit client, then they can put together the audit planning document. This document is the detail. It proves whether the auditor has planned the audit properly and includes all information needed to then carry out the rest of the audit process. Remember, this is not set in stone. Things change, and if things come to light that mean the conclusions made at the planning stage are no longer appropriate, then the plan must be amended. The planning document must be completed before the audit work begins and should be stored in the audit file. It should include the following: assessment of materiality and performance materiality, details from the analytical review performed at the planning stage, key audit risks, background information regarding the client in understanding the entity, any specific laws and regulations, staff booked for the audit team and budget set, the overall audit strategy, and deadlines set to ensure the audit process is completed on time. With the detailed evidence now in place, the auditor is now ready to continue the audit process and follow the plan to ensure an appropriate opinion is decided on the financial statements in the audit report. To summarise, we have covered the purpose of the audit plan, some specific reasons, and that overall it is to ensure the audit is effective. That the auditor spots risks relating to the audit by performing analytical procedures and understanding the entity and its environment. They must then decide the audit strategy, where they consider the scope, timing, and direction the audit should take. Materiality by size and performance materiality must be calculated specifically for the client using their judgment and the guidelines set for auditors. And a planning document must be prepared including all of the detailed decisions made for this audit. This plan may not be set in stone and could be amended during the audit process if necessary. I hope you found this video useful. Thank you for watching. This video is going to cover audit documentation. The auditor's objective is to form an independent opinion on the financial statements. In order to do this, they must gather sufficient appropriate evidence, perform audit procedures, and follow auditing standards and ensure ethical behaviour while carrying out their work. Auditors must prove they have carried out their work properly. They must therefore gather as much tangible evidence as possible so they can back up their opinion. ISA 230, Audit Documentation, states that the auditors must ensure they have written documentation that proves that the audit was planned and performed in accordance with auditing standards and any other legal requirements. Helps the audit team plan and perform the audit. Helps more senior members of the audit team direct and supervise, as well as review the work completed. Is a sufficient appropriate record of audit work completed to assist in forming the audit opinion, assists future audits, and enables the audit team to prove they did the work. Therefore, audit documentation needs to be detailed enough to ensure auditors can show evidence that the audit was conducted properly. For every audit client, the audit firm will keep files to organise the documentation collected. There will be a current audit file which will store all relevant evidence and documentation relating to the current audit. And there will be a permanent audit file which will store all client-related documentation that would be useful for current and future audits. This would include previous year's financial statements, client organisation structure, key personnel, contact details, and so on. All correspondence must also be stored so there is a trail of evidence that proves that communication between the auditor and the client is effective. For most audit firms, these files are now electronic. This is a more secure option of storing the information needed, plus it saves space in the office, which can reduce administration costs for an audit firm. The current audit file will back up the audit opinion. It should be completed in a timely manner over the course of the audit process, with the finalisation of evidence just after the audit report has been signed. These files must be retained by the audit firm for a minimum of 5 years from the date of the audit report. This enables the auditor to prove what they did. For example, if the client was to take legal action against the audit firm for negligence. The current audit file has 3 main sections: the planning section, audit performance, and completion. The planning section will document all of the considerations made during the planning stage and clearly show the direction the audit should take. The audit planning document must prove that the audit team planned effectively and will include the following: an assessment of materiality and performance materiality, details from the analytical review performed at the planning stage, key audit risks, background information regarding the client in understanding the entity, any specific laws and regulations, staff booked for the audit team and budgets set, the overall audit strategy, and deadlines set to ensure the audit process is completed on time. We can see that this is a very detailed document which reflects the importance of the planning stage. If the audit is not planned properly, it may cause significant problems later on in the audit, including possibly forming an inappropriate audit opinion. The audit performance section will include all documentation and evidence collected that relates to the audit procedures carried out. These are the audit procedures carried out on the systems, transactions, balances and disclosures relating to the financial statements. The audit procedures are carried out when the audit team is out at the client. The team must ensure that they can prove this work was carried out properly. Without this work and the evidence collected from it, the auditor cannot form an opinion on the financial statements. For every test carried out, the auditor needs to prepare something called working papers. These are several documents organised to prove the balance in the financial statements is true and fair. To illustrate, let's pick the bank and cash balance in the financial statements. The working papers relating to this will include a lead schedule, backup schedules, and audit programs. The lead schedule is the first document seen in the section for each balance. It will show the total balance which will agree with the balance shown in the financial statements. Therefore, for this example, it would show the total bank and cash figure shown under current assets in the statement of financial position. Behind this will be the backup schedules. These will be individual schedules for each sub-balance, which makes up the total balance in the financial statements. For example, If the client has 5 bank accounts and a petty cash float, there will be 6 backup schedules, one for each individual balance. They will all total to the front lead schedule. Then behind each of these backup schedules will be the audit programs. These are the detailed documents which explain the audit procedures carried out on the balance. They will be separate tests carried out on the current bank account, savings account, etc. Each of these tests will have a sheet explaining the test and its outcome in detail. Each audit program must show the following: the objective of the test, for example the financial statement assertion that is being tested, a description of the audit work being carried out, how the sample was chosen to test, the outcome or conclusion from the work carried out, shown clearly who did the work by a signature and name, the date it was completed, and who reviewed the work at the completion stage. Any other documents that back up this audit program are then filed behind in this section as additional evidence. For example, copies of the bank statements, the bank report, and the letter sent to confirm balances, and a copy of the bank reconciliations will all be stored with the audit programs. The third section is the completion area of the audit file. This is where the final review is carried out and post-year-end audit procedures are carried out. All evidence connected to this work should be stored together here. The key areas of the completion stage are the final analytical procedures, disclosure checklist for accounting standards, summary of unadjusted errors, a record of adjustments made since the trial balance was produced, the subsequent event review, the going concern review, written representations, the draft financial statements, and a draft management letter or report to those charged with governance. Again, evidence needs to be thorough and conclusions must be clear in this section. The review should be made by a senior member of the audit team, and evidence of who reviewed the audit work must be shown. The audit file and all of the working papers produced by the audit team belong to the auditor. Access to the working papers is only permitted if authorization is given by the auditor. Some of the reasons for this are that some of the information held in the file will contain sensitive information about the client. They therefore have a duty to protect this. If any of the work is lost or stolen, it would need to be recreated in order to form an opinion. This would be at an expense. There is a risk of evidence being tampered with. This could affect the opinion being formed at the end of the audit process. All evidence must be kept secure. To summarise, ISA 230 gives guidance on what documentation is needed for an audit and how it should be managed. Documentation is retained for the current audit, for relevant information to assist the auditor and any correspondence between the auditor and the client. Documentation for the current audit is split between the planning, audit performance and completion sections of the audit file. Evidence collected relating to the audit procedures carried out is referred to as working papers and must be sufficient and appropriate to prove the balance it relates to in the financial statements. Evidence who did the work and who reviewed it in the audit team must be present, and the documentation must be completed shortly after the audit report is signed. I hope you found this video useful. Thank you for watching.